What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is November 23rd of 2022. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, we've got to talk about what can only be labeled the Fed delusion. As Bitcoin and stocks have gotten beaten up over the past year, yet again, people are racing out to hope that the Federal Reserve is going to start slowing down its efforts towards tightening monetary policy, i.e. increasing interest rates and reducing its balance sheet. But I'm going to talk to you all today about why the Federal Reserve and the markets, for that matter, are in a catch-22, and why the Federal Reserve, on a fundamental basis, should not move away from its position. And if it does, why the pain is just going to get a heck of a lot worse. We got a lot of things to talk about in today's video. Let's go ahead and kick it off and drop a like if you enjoy the content. So let's go ahead and talk about this. Bitcoin has bumped up here over the last 48 hours from around $15,500, around $15,600, up towards around $16,471, almost about $1,000 bump up. And a lot of people are getting really excited, both in crypto as well as in equities, as we have been going through a bit of a relief rally over the past couple of weeks, or really over the past month since back in mid-October, due to the fact that the Federal Reserve might start considering loosening monetary policy efforts, i.e. starting to only do a 50 basis point hike or 25 basis point hikes and then capping it out there, and then eventually getting to the situation that everyone and the bullish side of things is hoping for, which is for the Fed to lower those interest rates, to start printing more money, just like the good old times, just like the sugar rush of the last decade. Whether people like to admit it or not, that's all investors care about. That's all Wall Street brokers care about, because it's how they get their bonuses. It's how they get essentially higher pay as they go towards the close of the year. They need you buying up stocks with that hope that the Federal Reserve is going to pivot. They need the market to rally, right? We are not a broker here. We don't have any incentives for the market to go one way or another. And in fact, I'm going to talk today about why the Federal Reserve is in a catch-22, meaning that there is no easy way out of this. And that means that there is no easy way out of this for equities. Let me go ahead and explain, okay? So we are calling for, and I just want to make my call here very clear, that the Dow Jones, right, we're using this as our base indicator because it has been the strongest index out of the major stock indices in the market. I believe that the Dow Jones and other indices have probably another 2 or 3 days of steam left in them for their rally, and they're going to start a topping structure in the near term and then begin a downtrend. And this comes at a time, an important time, of the Fed meeting minutes. Now, let's just go ahead and try to understand, before we talk about that macro sentiment and those factors, let's just go ahead and take a look at price here. Bitcoin is still, in the grand scheme of things, down in the dumps here. We have had no sign that the capitulation is completely over. We've had no long sideways consolidation here. So Bitcoin's price alone is not giving us any signs of confidence. Yeah, we might get a bump up into the Fed meeting minutes. Maybe the market is a little bit optimistic. Maybe it goes up $1,000 or a couple $100. So what? Is it a confirmation of the next bull market? That's all we care about here. And I got to tell you all, when I take a look at Bookmap, right, which gives us that market order flow data, I am not impressed whatsoever. When I take a look at this rally here in the Binance futures, while the market order flow is still relatively neutral, just a little bit positive at 3,900 points here for the past week, it has just taken us back to practically where we were here back on November 20th over the last 3 days. But when we really are trying to think about finding bear market bottoms, I like to focus on whether or not the spot markets, or in this case, Bookmap's unique tool, Multibook, which scans across the major liquid exchanges in the United States and in Europe to get real market data on the demand or lack thereof for Bitcoin. I like to see whether or not this indicator is showing multiple weeks of green market order flow when it comes to the CVD, or the cumulative volume delta, which measures generally are more people market buying or market selling, taking the best available price to get in or out of Bitcoin. And I got to tell you all, the CVD looks abysmal. Now, some people always generally stereotype that market order flow is generally just going to go part and parcel with where price goes, right? I mean, if price is going up, right, there's got to be a lot of market order flow. There's got to be a lot of demand for it, a lot of FOMO, a lot of buying the dip, right? Well, take a look at this. We're practically back where we were here on November 20th. The CVD here was around 5,600 points negative. We were in the red as we started a downtrend back on the 17th of November. That came all the way down to around 12,000 points to the downside. And with this bump up, this recovery, where we were originally around 6,900 to 7,000 points in the negative range, we are still at minus 10,000. So what does this tell us here? It tells us that sure, there are some bids getting filled, providing support for price, keeping it afloat to a degree. But on the heat map, right, those bids, there's not too many of them. Most of them have been exhausted. And on top of that, we don't have any strong bid side support here until 15,500, and no one is FOMOing in. No one is market buying. That is the kind of stuff you need to see to start a new bull market. You need to have incredibly strong bid support, right? Some may argue we're starting to get that now, right? We're getting people looking at the chops and stuff to be able to get Bitcoin at around 15K, but you need the market order flow for it. It's exactly what happened back in 2016. It's exactly what happened in early 2019 at the kickoff of every bull market. Now, if you guys are swing traders, like very short-term swing traders, you want to trade the momentum, yeah, maybe you can trade into the Fed meeting minutes. But this tells me here, and this is why I love Bookmap as a tool. It tells us the market structure of how price got to where it is and whether or not it has the footing to continue doing what it's doing. And this is the biggest red flag I can see here. And I really, again, I want to give a big shout out here to Bookmap. They've been one of our long-term partner tools here on the channel. And what's really interesting, if you guys like this kind of market information, there's a big Black Friday sale that you guys can tap into. The code you can utilize, I'll leave it all down below in the description, is BM Bookmap or BM Black Friday. So BM Black Friday, where you guys can be able to get 50% off of any of the plans here. But I think this is such a perfect time to talk about Bookmap because of the simple fact that the multi-book tool, a unique feature here that you can only get within Bookmap through one of the paid plans, is that essentially this is showing us there is not much bid side support. There's good chunk of resistance here at big even levels like 17,000. But there are not many big whales or buyers until we come right back down to 15,500. And that is why you need to understand the market structure of the heat map and the order book, as well as the cumulative volume delta through market order flow. These dynamics are what drive price. And until they change, things are not going to change when it comes to Bitcoin's price. Simple as that. Now, we focused a lot on Bitcoin, and as many of you probably remember the other day, we talked about how we believe Ethereum is still way overextended. This does not look like a bottom of a bear market. Ethereum holding up here. And I understand ETH is deflationary. I understand there's all these things that people are excited about. Maybe DeFi, NFTs coming back maybe one day. But the fact of the matter is, it's overvalued here. Simply put, guys, it has been sitting up in this range for too long, and we need to see it have a capitulation of it, right? We have not found capitulation enough for a bear market until altcoins and even Ethereum, yes, has capitulated, okay? So we understand these dynamics. I don't want to spend too much time on it, though, because I want to dive into this topic of the Federal Reserve and the upcoming events. Now, the FOMC meeting, I want to make sure I'm very clear about this. The FOMC meeting is going to be coming on December 13th to the 14th. This is where Jerome Powell, as he tends to do every month or 2 months, will come out and speak to everyone about the Fed's direction on monetary policy. He will likely announce a new Federal Reserve rate hike. That's pretty much almost guaranteed still at this point, unless something really changes here within the next few weeks. And on top of that, he's going to give future direction for monetary policy. But before that, we are going to get something known as the Fed meeting minutes. This is a summary when Federal Reserve members come together and discuss the current state of the economy. They'll usually cite certain data points and generally give hints to the next FOMC meeting where we can start to gauge what the Fed's thinking about doing in the coming weeks so we can start to price it into markets and start to plan for those events to a degree. So we understand what the Fed meeting minutes are. And if you look at the headlines, as a lot of people are reading now, whether it is brokers at firms, all the kind of people who have been telling us time and time and time and time and time again, trying to call bottoms, trying to say that the Fed's going to pivot. They are like the bears of the last decade during the secular bull run. They don't get it. They're not tuned in to the same channel that the Fed is in because their incentives are not aligned with following the reality. They believe, yet again, the Fed is going to signal some optimistic signs of pivoting, that they are going to revert course. Out of nowhere, they are going to start cutting back on their interest rate increases, and very soon after, signal that they're going to cap the rate and start lowering it. That's what everyone's hoping for. I mean, again, I understand people have varying perspectives, but if you listen to a lot of the bulls, a lot of the people who are already calling that the bottom is in, this is their general narrative, that the Fed is going to head back to easy times, the last decade of the secular bull market that we had been in. And this is the time to buy the dip, right? And I'm going to go ahead and talk about 2 reasons why that's not the case. Let's just go ahead and say, what if they're right? What if these investors are right for a moment? Many of you out there as well, and I don't mean this in a mean way, trust me, I think that all of us, with the mentality we've built for the last decade, loved investing and trading during a period of time of monetary easing. I know everyone wants to return back to that. There's an itch for that, but I have to be honest with you all. If history tells us anything, if the Federal Reserve starts to revert course with the type of inflation we have in this economy, if they start to backtrack and ease again in financial markets and bring equity values back to where they were back during the peak in November, the amount of inflation you are about to see in the economy, considering the demand that is going to come in with the lack of supply of those goods or services, oh my gosh, we are in for double-digit inflation. We are in for a very, very dark time. And the Fed will have lost all the progress. It will only have caused pain, right? It will only caused unnecessary pain to get us to a position that's worse off. And I say that as someone who loves to invest. I mean, again, guys, I would love for there to be a bull market tomorrow. That'd be great. But that is going to, in the long term, it is going to not only prevent a sustained bull market or secular bull run, because the Fed's going to have to come back and tighten even more. 10% inflation, even the inflation that we have now, is not normal. And it cannot sustain at these levels. Because if it gets too far out, you lose trust in the system. You lose trust in money. You lose trust in the supply chain. And it's important to understand that the Federal Reserve realizes this. It has made it very clear since the Jackson Hole speech in August, and even before that inflation is the number one priority. And the Fed has slowly but steadily warmed up to admitting that no matter what, it has to admit that it needs to tame inflation. Now, again, that's the kind of reality for the pivot crew, is that it's going to get a lot worse before it gets better if the Federal Reserve pivots. And this is why it's a catch-22, because if the Fed sticks course here, which is what we're claiming, the Federal Reserve needs to continue tightening, we need to understand that there is going to be more pain to come. And here is why. It's not just a matter of us discussing so much if the Federal Reserve is going to increase or decrease interest rates. That is a very key component, and it has a very big weight on the economy because it affects all of the borrowing rates in the economy, as well as the savings rate for individuals. But mainly, I want to focus on the thing that still the headlines and most market investors and market gurus out there aren't talking about, and that is the balance sheet. Now, I cannot beat this like a drum more than I am right now. The balance sheet is the biggest reason the Fed cannot pivot. I don't care if the Fed takes the federal funds rate to 5 basis points, 5.5, even 6 basis points. There is a pretty big magnitude of difference in those interest rates. Some businesses will succeed in a 5% interest rate environment, or at least be able to sustain themselves, versus a 6%. But the thing that really matters when it comes to the production of upward returns in financial assets has to do with the balance sheet. It has to do with the Federal Reserve's tightening on monetary policy when it comes to its mortgage-backed securities, holdings in U.S. Treasuries, you name it. And guys, I mean, again, I'm gonna sit here quietly for a minute. Look at this chart. $8.6 trillion. That is, from back where we were in 2008, nearly 10 times the base money supply. Right now, we've talked about a lot of things here in this channel. We've talked about how oil prices and natural gas, while many would argue they're in a downtrend, they're kind of pushing sideways. They've been doing so really since the summer. And we also talked about how housing inventories, with mortgage rates at, historic 20-year plus highs, meaning that no one's taken out a mortgage right now. Mortgage volumes have dropped 90-95%. Housing inventories are still remaining elevated. Prices really haven't started to decline. What's going on here? It's because there's too much money in the system. People are buying houses with cash outright. That is not normal, at least not to the degree at which we have it right now. There's still too much money in the system, buying goods and services, all that stimulus money, all those PPP loans that went to businesses, many of which probably didn't even deserve them. A lot of corporations, even companies like FTX took them out. Hundreds of thousands, millions of dollars, billions of dollars that they probably didn't need. There was a lot of corrupt, easy money over the last couple of years, and until that gets washed out, inflation is not going away. You can bet on it. And this is the thing that takes us where we are now and defines that we are separating from the past decade of easy money. The Fed cannot cool the economy like it did each and every time when we had a dip in equities, when we had a pullback in crypto. The Fed doesn't care about Bitcoin's price, and to be honest, this is the thing that investors need to have as a wake-up call. They don't care about what's going on in equities right now. They care about taming inflation. And in fact, there's a very important dynamic to understand is that if equities rally too high, right, this is likely, if anything, going to mean more likely than sustaining a bull market that people are going to sell equities who weren't selling before. That means more cash in the system, more likely to go out and spend it on things to pay for the ever-increasing cost of living. Right? This is the same thing that whether there's inflation or not happens in each and every bear market, right? We've talked, again, we can take it back. We've also, right, see the Dow Jones. If we go all the way back here, same exact kind of price setup back in the 90s and the early 2000s. Dow Jones held really strong because it has those defensive stocks. It is the leading indicator during inflationary periods and also just in typical recessions, because they're the most established companies. They pay the best dividends. That's all the kind of stuff you want to look, predictability in financial reporting. But even the Dow Jones, like we've seen in this cycle, set in new lows each and every time, and it dragged on and dropped much lower than people thought, over 30 to 40% from those previous highs. And take a look here at what price is doing now, deviating time and time again at that 200-day moving average, just like we did back 20 years ago. Starting to dip below that 200-week, giving you the hints that this is not like the past decade, right? Where everyone usually bought the dip at around that 200-week moving average. Now, there's a couple of charts here that I think really stand out. Take a look at the VIX. The VIX measures volatility, i.e. when the VIX goes down, equities are moving up usually, and vice versa. When the VIX goes up, when there's uncertainty and spread within the options for the S&P 500, that's what the VIX measures. When they're going up, this means equities are likely going down. There's fear and uncertainty. Now take a look at this chart and tell me, have we seen this play out before? Right? The downtrend we've had from mid-October in volatility. The return of optimism. Have we seen this before? I feel like, even though it's cold outside, it feels like it's the summer. It feels like August, when everyone was saying that this was the start of the next bull market, the lows are in, the Fed's going to save us. I got a feeling that whether it's in those Fed meeting minutes or the FOMC meeting coming up later in the middle of this month in December, Jerome Powell's going to bring the hammer down. He cannot have financial markets start to ease and expect easing of monetary policy. He needs to be direct, and he needs to remind everyone that inflation takes time. And even if today, let's say, where we are still far away from the 2% target of inflation, that people just think that Jerome Powell is going to totally start to break away from, the 50-year plus cited target of 2% that the Fed has always practically had as a target for stabilized inflation. Many people believe that the Fed's not going to go for that. I'm just going to go ahead and put my money on it. They are. But on top of that, I think that if we hit 2%, let's say we were there today, the Fed's just going to immediately pivot, right? That's when they can start to ease. No, the Federal Reserve needs to keep it at 2% for a sustained period of time. And that's why, again, I think that the VIX is going to, like it has, and I'm going to zoom out here, I think the VIX is going to set in another higher low. It has been doing this since 2017. And this speaks towards the broadening uncertainty that something big is about to happen. We've got a lot of companies out there, a lot of investors who took too much risk and made too much dumb money over the last decade. I'm not here to insult anyone, but those people know who they are. Those who are over leveraged, who are overexposed, who didn't have to do much, but just simply catch a wave early on. Look at this chart and tell me if you really disagree with what I'm saying here, right? It's, again, everyone's got different opinions. I'm not perfect. We've made some wrong calls here on the channel. So take what I say with a grain of salt alongside many other commentators. But this, to me, is scary. And I don't know if the dollar is going to dip down below here, deviate higher, whatever. But I got to tell you guys, the dollar has been on a really solid uptrend. And just because we've had a decent dip here, right? Just because we're kind of riding along that 200-day moving average, right? Let's see how it reacts here. Let's see how it goes in the FOMC meeting. Now, again, one thing that I think is important to realize, I know a lot of you are wondering, Nick, like, okay, you believe we're in a bear market. You believe that right now it's a difficult time, to go out and really find long-term holdings. What are you doing right now? Well, right now I've been predominantly in cash. But one thing that I think is important for all you guys to know is that there is opportunity out there in the market. There are plays out there right now where you can both bet against the market, but even ironically enough, still go long on certain plays. But you got to know which stocks are leading in the market. You have to know which ones are going to buck the trend and be able to still go up. In this past month, in the Dash Report, our newsletter, we sent out 3 stocks that we were watching, 3 setups that we were looking at in the month of November. And man, did these pay off. We had one of our plays here, Puma Biotechnology, PBYI, that we've called for actually about 2 months now, that it was eventually from this range going to have a reverse or inverse head and shoulders pattern and reverse up towards this range in double-digit territory. And so far, we have been ahead of the rough trend line we've been looking for, up 104% in the past few weeks. Not even a full month, up 104% from our initial recommended point. Outside of that as well, while they aren't as good as performers at PBYI, are other stock recommendations in the energy sector that are focused on transportation of oil and natural gas to European markets, like DHT Holdings, up 13.5%, and TNP, while it was up a decent amount the other day after having a not so good earnings report, is still relatively flat here from entry, not in the red. I wanted to share all 3 of them with you guys because I'm not here to be a charlatan or to tell you guys that I've got all the answers, but we are spotting those trades, whether it be in equities or in crypto. And while we're not taking too much action right now, I at least want to do my best to show you all how I go out there and I find the value plays in this market. It's a lot more difficult to find those winners in a market where things are generally trending down. And that's why sometimes we have to mix in those plays that are market leaders that we go long on when they give us good discount opportunities. And on top of that, we also will look out for shorting opportunities. Now, again, I'm not going to provide all the details here today, but I want to let you all know, I think the Dow Jones is signaling very clearly that while we are not there today, in the next week or so, as we go into the month of December, that the short-term relief rally that this is going to yet again play out like it did back in August, once Jay Powell slams down the hammer. So if you guys want to stand by me in this case, if you want to learn a lot more about my insights on the macro perspective of things, if you like the kind of content here, if you've stayed this long for the rambling, you can always check out the Dash Report down below in the description, and you can get 20% off if you sign up with a yearly membership. Feel free to try it for a month, and if you like it, definitely check out the yearly subscription. It's totally fine. But we've been keeping our prices steady, guys. I understand inflation is crazy now. I want to be reasonable, but it's a great way where you guys can support the channel. And on top of that, you not only get a newsletter where I'm talking about crypto, stocks, commodities, and Forex, the whole macro perspective, but on top of that, you get mid-month webinars. You guys get to join the Telegram alerts group where you guys get my trade alerts or long-term investment buys. You'll get to be able to see my portfolio stats for crypto, be able to engage in the Dash Report discussion group, talking to some of our best members in the Dash Report community. There's so many things that come in this newsletter. And we've just constantly added value while keeping the prices at the same level. Because I'm really big about supporting you guys as much as possible if you guys can take the time and effort to be able to support us here on the channel. It means so much. But if you can't afford the Dash Report, it's no worries. Also, just consider dropping a like. It's another great way to support the channel. But I'm curious to hear what you guys think about all this, right? Again, I don't want to be too confident on anything, but I got to be real with you all. Seeing the CPI reports, seeing the PCE numbers that are coming out, I just simply can't remain bullish at these levels for Bitcoin. Not to mention the continued contagion, Genesis, so many other players that are still getting knocked down. If large players like Genesis and FTX and Celsius were this over leveraged, how are the smaller and mid-sized players doing? I think there's going to be a lot of dominoes going throughout this space for the next year or so. And we got to be vigilant and prepared for lower prices. We got to wait for the market to give us the signs that it's ready to start kicking higher. Anyways, guys, that's it for today's video. Consider dropping a like if you enjoyed it. Have a wonderful rest of your day, and I'll see you all on Friday. Take care, everyone.